Hi, welcome back to another video. ETFs are considered the most powerful way to get rich in the stock market, and for good reason. They are highly diversified, which helps investors manage the volatility in the stock market. They're based on a fixed formula and therefore they're passively managed, and so this makes them inexpensive to invest in. And because ETFs, like index funds, are put together by financial companies or professionals, think large brokerages like Vanguard, BlackRock, Schwab, Fidelity, and so on, investors do not require technical skills or professional skills in finance or investing to invest in ETFs and index funds because all the dirty work has already been done for you. In fact, when I first started investing in the stock market in 2021, all my investments were in ETFs. If you want to get rich investing in the stock market and you want to do so with minimal anxiety over market volatility and passively, ETFs and index funds are the ways to go. However, there is a right way and a wrong way of going about investing in ETFs and index funds. And in this video, I will share with you the do's and don'ts of investing in ETFs if you want to get rich investing in ETFs. But first, what's an ETF? An ETF is an exchange-traded fund. A mutual fund, it is a kind of mutual fund like an index fund. It is a stock made up of multiple other stocks, a bundle of stocks, and there can be as few as 50 stocks or thousands of stocks in one ETF. Like VTI. VTI is Vanguard's total stock market ETF, and it tracks the entire US stock market. It's made up of thousands, more than 3,500 stocks in this one ETF. And so by investing in VTI, for instance, you own a really tiny piece of every publicly listed company in the US market. The other thing to note about ETFs is that, like index funds, they're based on a fixed formula. That's why they're passively managed. An ETF, like index funds, tracks a specific index or indices such as the S&P 500, the Dow Jones, the Nasdaq, the TSX or the FTSE. Usually the description of the ETF will tell you what index it tracks. Now, what's the difference between an ETF and an index fund? ETFs can be bought and sold like individual stocks anytime the stock market is open, intraday trading. And the price you see on your screen is what you're paying for your ETF. However, for index funds, you can buy them anytime during the day. However, the price at which you close a deal or a transaction is only confirmed at the end of the day. The price you see on your screen during the course of the trading day is not necessarily the price at which you're going to close a deal. Usually, the price at which you buy or invest is confirmed at the end of the trading day, after the markets have closed generally. The other difference between an ETF and an index fund is that often there's a minimum requirement to start investing in an index fund. Here is an example. Vanguard's VTI, the ETF that tracks the entire US stock market, does not have any minimum requirement when you start investing in this ETF. However, VTI has an index fund equivalent, here we go, called VTSAX. In order to start investing in VTSAX, there is a minimum requirement to start with $3,000. So that's another key difference between ETFs and index funds. Oftentimes, to start investing in an ETF, you can start by just buying a single stock of VTI, for instance, which is currently trading for about $295. If you invest in a brokerage that allows for fractional trading, you can start a position by just investing $10. Buying a little tiny fraction of that ETF. So that's another key difference between ETFs and index funds. Last but not least, because when investors trade in ETFs, they are trading with each other during the course of the day. ETFs tend to have some kind of tax efficiency or advantage over index funds. Now, how do I find ETFs? Great question. You can learn about ETFs from other investors, from family and friends. You can just do a Google search if you have a specific ETF or index fund in mind. I have a popular ETF website that I tend to go to. It's called the ETF database. And so here we go. So this is the ETF database, f.i.r.e. On this website, you can search for different ETFs by ETF type. There's an ETF screener. ETFs by geographical regions, ETFs by issuers. Let's click on this. Let's drill down on ETFs by issuers and see. You can see some of the larger ETF issuers here: BlackRock, Invesco, State Street or Spider, Vanguard, JP Morgan Chase, and so on. And you can see the volumes in terms of revenue. You can see how many ETFs they have out in the market. Let's go back. You can also search this website by ETF type, or you can search by what are the most popular types of ETFs. By real estate, this is by sector, and you can search for ETFs by dividend ETFs, aggressive growth, different sectors, healthcare, blockchain, and so on. Technology, let's look at dividends, for instance. I love dividends, so let's look at dividend ETFs. You can see here, dividend ETF list. And so when you drill down here, you can further drill down by average volume, daily volume of an ETF that's traded. SCHD is a very popular Schwab ETF. And you can see the price for the day, change for the day. You can VYM, that's a Vanguard high dividend ETF. So you can drill down by your preferences. Let's look again, drill down by ETF type. And so here you can drill down by sector, for instance, or industry. So there are currently 11 sectors in the market. And so here they are. If you wanted to search for ETFs in the real estate sector, you can click that and you see real estate ETFs. And then you can drill down again by volume, by the previous day closing price. You can drill down by assets under management, and so on. When we drill down by popular ETFs, you can drill down by aggressive growth ETFs if you're looking for growth in the stock market. QQQ, that's a very popular Invesco growth ETF. VUG, VGT is a technology ETF. And so this is the ETF website. If you want to just search it up, look up ETFs that may be of interest to you based on sectors and so on. Now, for completion, I currently have 5 ETFs in my portfolio, and they include VTI, which is Vanguard's Total Stock Market ETF, XIC, a BlackRock ETF that tracks the entire Canadian market, SCHG, that's a Schwab Large Cap Growth ETF, SPLG, a Spider S&P 500 ETF, and I have SCHD, a Schwab Dividend ETF. So those are the 5 ETFs I currently have in my portfolio, just for full transparency. Now, if you enjoy content like this, please consider liking this video and subscribing to my channel. It helps the channel grow. It also encourages me to continue making these videos. Let's look at the do's of investing in ETFs. The first key step of investing in ETFs is to set a financial goal. Let me explain. By setting an investment goal, you'll be forced to consider a couple of things. One is your time horizon. If you have a longer time horizon, say 20 or 30 years down the line, consider investing in growth ETFs because you have ample time to recover from any kind of market downturns. Having an investment goal will also help you to determine what you're looking for in the market. Are you looking for growth or for income, cash flow? If you're looking for cash flow, in which case you will want to preserve your capital as well, then your choice of ETFs will probably be narrowed or focused towards dividend ETFs or bond ETFs. Dividend ETFs are obviously good for cash flow, and bond ETFs are good for both cash flow and preservation of your capital because they're not so prone to market volatility. So having an investment goal, or your why, is the first step in selecting the most optimal or the most appropriate ETFs to invest in so that you're not forced down the line to sell out of a position and reinvest in something else, because oftentimes there's a cost with selling any stocks, including ETFs. Here is a small table I put together of some common dividend ETFs. This is not definitive, and you should not take this and invest in this. Do your own research, like I just shared with you, the ETF database. VYM is a popular Vanguard dividend ETF. SCHD, a Schwab ETF. SPHD is a high dividend, low volatility Invesco S&P 500 ETF. XEI, a BlackRock ETF. The table has the market in which the ETFs are listed as well. Here is another quick table of more common growth ETFs. VUG is a Vanguard Growth ETF. VGT is a technology ETF. VOO, IVV, SPY, SPLG, VFV, these are all S&P 500 ETFs. These are growth ETFs because the S&P 500 is dominated by technology companies which grow at an above market average rate. The second due of investing in ETFs is to start by investing in broad market ETFs, like the S&P 500 ETFs or total stock market ETFs, because they are the most highly diversified. The stock market is a very volatile place, and so you can build confidence or get discouraged all in very short order. By starting with broad market ETFs like the S&P 500 ETFs or total stock market ETFs, you will find that you will have comfort and build confidence a lot faster. Here is an example from my own experience. When I first started investing towards the end of 2021, the markets were at an all-time high. And so that was a very heartwarming time to be in the market. However, my first full year in the market, 2022, the markets were down for the whole year, about 20%. So imagine if somebody started by investing in the financial sector, for instance, which was significantly impacted by the downturn in 2022. You might have been very discouraged. Here is a quick table of some popular broad market ETFs. VTI, of course, is Vanguard's total stock market ETF. XIC is a BlackRock ETF that tracks the entire Canadian market. VOO, IVV, SPY, and SPLG all track the S&P 500. SCHB is a Schwab total stock market ETF. ITOT, a BlackRock total stock market ETF. Now, this is not a conclusive list by any measure. Do your own research, but consider starting by investing in a broad market ETF to have a firm, stable foundation that will prevent you from getting anxious about volatility in the stock market. Investing in sector-specific ETFs or niche ETFs should come way down the line once you have a firm and well-established portfolio based in broad market ETFs. The third step of maximizing your investment in ETFs is to dollar cost average into your investments. Dollar cost averaging is basically to set up automated contributions into your investment account. A fixed amount is contributed every month or perhaps based on your paycheck so that you are contributing into the portfolio consistently, whether the market is high or low or flat. Research has shown that people who contribute into their portfolio, into their investments consistently end up outperforming even people or investors who are able to always time and contribute at the bottom of the market. By contributing consistently, you're always in the market, you're always present, and you're buying all the time. So buying low, high, and flat evens out the impact of volatility on your investments. The other consideration closely behind dollar cost averaging is electing to turn on a DRIP. A DRIP is basically a dividend reinvestment plan, so that every time you receive a dividend payment on your portfolio, that amount gets reinvested immediately into that position. By so doing, you're not letting cash sit on your account for when you have time, then you can jump onto your portfolio and buy stocks. And that is part of what makes for compounding and exponential growth. Now, some actions to avoid in order to maximize your returns in ETFs. Avoid ETF overlap. An overlap is when you hold ETFs that have the same stocks or securities in them. For instance, if you held VOO and VTI, one is a subset of the other. All the stocks in VOO, which is the S&P 500 ETF for Vanguard, can be found in VTI, which tracks the entire US stock market. So by holding VTI and VOO, you're having significant overlap. Now, one key benefit of investing in ETFs is diversification. By holding ETFs with the same securities or stocks within them, you eliminate the benefit of diversification. While there is no hard and fast rule of what constitutes an unhealthy overlap, if your ETFs have at least 30% overlap, it's time to keep an eye on them. In fact, if you have ETFs with more than 60% overlap, then it's time to review your portfolio and potentially consider divesting out of some positions and redeploying that money to ensure maximum diversification of your portfolio. because diversification is a key tool against market volatility. Now you ask, how do I know if there's overlap between my ETFs? You can run a quick analysis. Here is an example. If we look at the sector weighting or the sector composition of both VTI and VOO, you'll see that both ETFs are dominated by technology, by financial sectors. Right there is an indication that there is likely to be a major overlap. Now, in addition to manual analysis of ETFs, you can also do a research on ETFs by running them through different websites online. A very popular ETF research website is the ETF Research Center that I visit often. Here, let's determine the overlap between some ETFs by running them through the overlap research tool at the ETF Research Center. So this is the ETF Research Center. You can find it here at the etfrc.com. And remember how I earlier indicated that VOO is a subset of VTI, and therefore there's bound to be a significant overlap. Here we go, VTI and VOO. And if you go find, oh, this was already pre-populated because I'd done that. So here we go. You'll see that more than 99% of VOO can be found in VTI. It's also reflected in the chart here. And let's try something else. How about VOO, the S&P 500 ETF plus SCHD? That's a Schwab dividend ETF. And we go find overlap. There we go. There is much less overlap. And you can see here that about 43% of SCHD is in VOO. You can see in the chart here that there's a 7% overlap. So this is a good match to have both VOO and SCHD in your portfolio. How about having VOO and say SPLG? Because both of these are S&P 500 ETFs, you're going to see there's 100% overlap. There we go. Because both SPLG and VOO track the S&P 500, you're going to see there's practically 100% overlap. Let's see VOO and VU. VOO is an S&P 500 ETF. How about VNQ? That's a real estate ETF. Both are by Vanguard. If you find the overlap, here we go. There's only a 2% overlap. 22% of VNQ is in VOO. So investing in VOO, an S&P 500, and VNQ, a real estate ETF, would offer optimal investment in your portfolio. So the ETF Research Center tool is one of many tools you can use to determine whether there is overlap between your ETFs. I think Vanguard has one such similar tool as well. And if you don't want to do any manual analysis, you can find websites in which you can run your ETFs for comparison so that you are not diluting the impact of diversification in your portfolio. Next, another thing to avoid when investing in ETFs is to avoid investing in sector-specific ETFs, especially earlier in your investment journey. Remember, a key benefit of investing in ETFs is diversification. So by having a large position, say 2 or 3 ETFs that track the same sector, you eliminate the benefit of diversification. If you hold 3 REIT-based ETFs, for instance, chances are the individual stocks within those REIT ETFs are very similar. By investing in sector-specific ETFs before having a key position in broad market ETFs, you're eliminating the benefits of diversification. Last but not least, don't blindly invest in or follow trendy ETFs. That's not very different than following or investing in popular individual stocks. The risks are high. If there was a little hiccup, you could lose significant amounts of money. Now, please note that when you first start investing in the stock market, your portfolio largely grows through your contributions, and consistency is key. Just because you're investing in ETFs is not a magic wand, and you cannot expect that overnight you will be rich unless you do the hard work of consistently contributing and remaining focused on your goal. Anyway, I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing, share with family and friends. I'll see you in the next one.